Everyone keeps talking about Tesla's car sales numbers. Delivery reports, quarterly results, price cuts, market share against Ford, GM, Toyota, BYD. That entire conversation is completely missing the point. Because while the auto industry is laser-focused on how many Teslas rolled off the assembly line last quarter, Tesla has been quietly redirecting billions and billions of dollars into something that has almost nothing to do with selling you a car. And the numbers, when you actually sit down and look at them, are so dramatic that it raises a genuinely uncomfortable question. What if Tesla's car business is just the opening act? Let's start with the money, because the money is where this story actually lies. In 2025, Tesla spent roughly $8.5 billion in total capital expenditures. That is already a staggering number. But then Tesla announced its plan for 2026. More than $25 billion. That is a threefold increase in a single year. And here is what makes that number truly extraordinary. The majority of that capital is not going toward building more electric vehicles. It is going toward artificial intelligence infrastructure, humanoid robots, autonomous taxi networks, and energy storage systems. Tesla is not scaling up to sell you more Model 3s. Tesla is scaling up to become something the auto industry has never seen before, and frankly does not have a category for yet. To understand why this matters, you have to follow the money inside the company, not just the total spending figure. Look at where Tesla has physically placed its biggest bets. At Gigafactory, Texas, Tesla has deployed 50,000 NVIDIA H100 GPUs inside what the company calls the Cortex cluster. Then they added 16,000 H200 GPUs on top of that, bringing the total to the equivalent of 67,000 H100 GPUs. And that is just the beginning. By 2026, Tesla is targeting approximately 155,000 NVIDIA H100 equivalent GPUs, representing an additional $4 to $5 billion in AI training hardware alone. To give you a sense of scale, that is more raw artificial intelligence compute than most governments on Earth have access to. Tesla is building one of the largest AI training infrastructures in the world, and most people covering the company are still writing headlines about quarterly delivery numbers. Then there is the $2 billion investment in xAI, Elon Musk's separate artificial intelligence company. Tesla closed that deal in the first quarter of 2026, and here is the part that rarely gets mentioned in the coverage. Tesla did not make that investment as a financial bet on a startup. Tesla disclosed that the xAI investment is, in their own words, part of Tesla's broader strategy under Master Plan Part 4, specifically to bring artificial intelligence into the physical world at scale. Tesla is already supplying Megapack battery systems to power xAI's data centers. This is not a passive investment. This is infrastructure integration between two companies that share a strategic vision and a chief executive. The line between Tesla and xAI is blurring on purpose. Now let us talk about Optimus, because this is where the narrative gets either visionary or completely detached from reality, depending on how you look at it. Optimus is Tesla's humanoid robot program. It walks on two legs, has hands, and is designed to eventually perform physical labor autonomously. In January of 2026, Elon Musk stated that by the end of 2026, Tesla plans to have the capacity to produce 1 million Optimus robots per year at the Fremont factory in California. To make room for that production line, Tesla made a decision that should have been the biggest automotive industry headline of the year. They ended production of the Model S and Model X, two of their longest-running vehicle lines, specifically to convert that Fremont factory floor to Optimus robot manufacturing. A car company voluntarily ending car production to build robots. When was the last time you saw that in the automotive industry? And yet here is the honest reality check embedded inside that announcement. As recently as January 2026, Musk himself admitted that no Optimus robots are currently performing, quote, useful work at Tesla. The first generation designed specifically for mass production, called Gen 3, was only unveiled in the first quarter of 2026. Production is expected to begin before the end of 2026. So the company is making an enormous factory conversion decision, betting billions of dollars on a product that has not yet demonstrated commercial viability at scale. That is either the boldest industrial bet in modern history or a capital allocation disaster waiting to happen. And the honest answer is we simply do not know yet which one it will be. What we do know is that Tesla is treating this bet as central to the company's future, not as a side project. Musk has said on multiple occasions, and this is a direct reflection of his stated views, that Optimus has the potential to be more significant than the vehicle business over time. He has suggested it could represent more than 80% of Tesla's future value. Those are extraordinary claims. They are not supported by current revenue, which is zero from Optimus. They are supported only by the internal conviction that humanoid robots performing physical labor will become one of the most economically important technologies of the next 2 decades. Think about what that bet actually means. If you need labor for manufacturing, logistics, warehousing, construction, elder care, or any number of physically demanding industries, and you could replace or supplement that labor with autonomous robots that do not get tired, do not require health insurance, and improve continuously through software updates, the economic implications are genuinely hard to overstate. Whether Tesla is the company that captures that opportunity is the open question. The robotaxi story follows a similar pattern of massive long-term ambition combined with much more modest current reality. Tesla's fully autonomous, unsupervised ride-hailing service has been one of the most anticipated and repeatedly delayed technology deployments in the industry. As of early 2026, Tesla's robotaxi service operates in only 2 locations, Austin, Texas, and the San Francisco Bay Area. And in those locations, a human supervisor is still required during rides. This is not the autonomous future that was promised. Musk has stated publicly, including at the World Economic Forum in January 2026, that he expects widespread deployment across the United States by the end of 2026, and expansion to 30 cities by that same deadline. Whether that timeline holds is something analysts are genuinely skeptical about, given the history of autonomous vehicle deployment promises across the industry. But here is where the financial analysis becomes interesting rather than just speculative. Cathie Wood and the research team at ARK Invest have published analysis suggesting that robotaxi, as a category, represents an $8 to $10 trillion economic opportunity. That is not a Tesla-specific forecast. That is an assessment of the total market that becomes available when autonomous vehicles can move people and goods without human drivers. If Tesla captures even a modest percentage of that opportunity, the economics of the company transform completely. You are no longer valuing a manufacturer by how many units it produces. You are valuing a software and infrastructure platform by how many rides it coordinates and what it charges per mile. That is a completely different business model with completely different margins. There is one part of Tesla's current business that does not require any optimistic future projections to make a compelling case, and it is the part that Wall Street consistently undervalues. Tesla's energy division generated $12.5 to $12.8 billion in revenue during 2025, representing 27% growth year over year. The gross margin on that business was 29.8%, which is nearly double the margin Tesla earns on its automotive segment. In the fourth quarter of 2025 alone, the energy business generated $1.1 billion in gross profit, a record number and the 5th consecutive quarter of record performance. Tesla deployed 46.7 gigawatt-hours of energy storage capacity in 2025, a 48% increase over the prior year. The 3-year compound annual growth rate on that business is 168%. And it gets more concrete than that. Tesla has disclosed that it expects to recognize $4.96 billion in revenue during 2026 from already contracted energy projects sitting in its backlog. That is deferred revenue that is essentially locked in before the year even started. For context, that backlog alone represents a meaningful portion of what Tesla's entire energy business generated in 2024. The demand for Megapack battery systems, which store energy for utilities, data centers, and industrial customers, is significantly outpacing Tesla's current ability to supply it. This is not a speculative future business. This is a high-margin, fast-growing business that is already operating and generating real cash flow, and it barely registers in the public conversation about Tesla. Here is where the broader pattern becomes visible if you step back far enough. The vehicles collect data. Hundreds of millions of miles of real-world driving data flowing back to Tesla's AI training clusters every single day. That data trains the artificial intelligence systems. The AI systems improve full self-driving capability. Better full self-driving enables autonomous vehicle operation. Autonomous vehicle operation makes the robotaxi network commercially viable. The same AI development pipeline also trains Optimus, because teaching a robot to navigate a factory floor or a household environment requires the same foundational capabilities as teaching a car to navigate an intersection. The energy business powers the compute infrastructure. The compute infrastructure runs the AI powers everything else. These are not separate business units pursuing independent strategies. They are a single integrated system designed around one central bet: that physical world artificial intelligence is the most valuable technology of the next generation, and that Tesla is uniquely positioned to build it. This is the part of the story where you have to ask yourself a genuinely uncomfortable question. Do you think the market understands what Tesla is actually building? Because if the answer is no, if Wall Street is still primarily valuing Tesla as a car manufacturer with some interesting side projects, then the gap between the current stock price and the actual value of what Tesla is constructing could be enormous in either direction. It could be a massive undervaluation if the robotaxi network scales, if Optimus achieves commercial production at anything close to the stated targets, and if the energy business continues growing at triple-digit rates. Or it could be a massive overvaluation if the timelines slip again, if the technical challenges prove more stubborn than anticipated, and if competitors close the gap in autonomous driving before Tesla monetizes its lead. The historical parallel that keeps coming up in serious conversations about Tesla is not Ford or General Motors. It is Amazon. In 2003, Amazon was a bookseller that had expanded into general retail. Most analysts were focused on whether Amazon could compete with Walmart on price. Almost no one was paying attention to the fact that Amazon was simultaneously building the infrastructure for what would eventually become Amazon Web Services, now the most profitable division in the company and the backbone of modern cloud computing. The retail business was never the destination. It was the cash flow engine that funded the construction of something much larger. The question you have to sit with is whether Tesla's car business is playing the same role right now. So here is what I actually want to know from you. When you look at what Tesla is spending money on, the humanoid robots, the GPU clusters, the autonomous taxi network, the energy storage business, which one of those do you think has the strongest shot at actually delivering on its promise within the next 5 years? Not which one sounds the most exciting. Which one do you think has the clearest path to real revenue at a scale that changes the company's fundamental value? Drop your answer in the comments, because this is the exact kind of conversation that changes how you think about technology investing and the future of the auto industry. 20 years from now, the history books are going to have to make a decision about how to categorize Tesla. Was it the electric car company that disrupted the auto industry? Or was it the AI and robotics company that used electric cars to fund its transformation into something the world had never seen before? The cars are still rolling out of the factories. The delivery numbers are still being counted. But somewhere underneath all of that familiar automotive activity, billions of dollars are being quietly redirected toward a future that has very little to do with the vehicle in your driveway. And the companies, the investors, and the consumers who figure that out first are going to be the ones who are not caught off guard by what comes next. For more investigations into what is actually happening beneath the surface of the auto industry, join us here at Driven to Distraction, because the most important story is almost never the one on the front page.